What's up, guys? Hope you guys are doing well. Hey, wanted to post a video for you guys. It's been a little while since I posted a video, wanted to do it. There's on something called a cap rate or a capitalization rate, okay? This is essentially, if you're gonna make an investment, if you're gonna buy Verizon stock, or if you're gonna buy a house or a multifamily property or a hotel, you're gonna be able to find out, do a quick analysis on its value. And so let's just say you had $100,000 to invest, and you were thinking about buying Verizon stock that gave you a 3% dividend return, or you were thinking about buying a house, paying cash for a house. Which should you do? Well, this is going to help you understand how that works. So guys, before I dive into it, if you have not subscribed to my YouTube channel, it would be really great if you would. What it does, when you subscribe, like, or comment in my YouTube channel, what it does is it amplifies its presence in the internet. Other people are able, other like-minded investors are able to find my stuff and be able to benefit from it as well. If you find benefit from it. If you don't, obviously click through, no worries. All right, guys, capitalization rate. You might want to get a pen and paper for this because it's not heavy, deep stuff, but it's going to show you a quick way to do it. So a lot of people ask me, Brian, how in the world do you submit so many offers, and how do you do it so quickly? People get so overwhelmed in the minutia of a deal that they can't do it. So this is really essentially how I can do it. All right, so here we go. Capitalization rate, cap rate. Cap rate is only this. It's the net operating income divided by the cost or the value or the purchase price of a piece of real estate. Okay, I'm going to show you an example here in a second. Again, it's easy math. You just need a calculator, hit the divide button, right? So the cap rate is the net operating income divided by the cost. All right, here we go. Say you're looking at a house. Okay? You know, your realtor just sent you a house this morning. You open your email and you're looking at it. Wow, okay, this is a 4-bedroom, 2-bath house. Purchase price is $167,000. Cool, nice neighborhood, newer area. It seems like a pretty sweet price. Let's just say in your mind you think, oh man, that house is probably worth $200,000. So I'm buying it, $167,000. You know the area. Okay, so here we go. The income on this house, you know, the real estate agent says, okay, the tenant is paying $1,200 per month. Okay, so now we know the annual income for that is $14,400. So $1,200 times 12, right? $14,400 is the gross income for this 4-bed, 2-bath house, all right? These are all annual expenses, by the way. Annual income and expenses. The expenses here are $8,126, and I'll cover this here in just a second. There's a lot that goes into this number, obviously, and this is where people get trapped in the minutia of a deal, and so I'll cover that in just a second. But the net operating income, in other words, it's the income minus the expenses, the net operating income. Once you know the NOI, or the net operating income, that is $6,274 per year. Okay, that's an annual figure. Net operating income is your $6,274. So you're thinking, okay, I got $167,000. Should I buy Verizon stock with that and get a 3% dividend? Or should I go ahead and buy this $167,000 house and get cash flow from that? What's the better investment, okay? And there's a lot of criterion, obviously, to deciding what you want to invest in. But let me just step back for a second here. Cap rate does not have anything to do with the debt on the property. So we're not going to necessarily talk about how you're going to buy that. We're just assuming with a cap rate that you have cash to pay for it. This is not factoring in any debt or debt service. Okay, a lot of people make that mistake when they're trying to work up a cap rate, and they're like, "Oh man, how am I gonna? I'm gonna borrow the money from the bank to pay the mortgage. How does that work into this?" And that's fine. I can cover that in another video. But for right now, when you're looking at dollar for dollar, asset for asset, what is the best way to be able to invest in that? Okay, so your net operating is $6,274. So here we go. We're gonna find the cap rate. You take $6,274 and you divide that by $167,000. So this, of course, is the net operating income, right? Net operating income. Income minus the expenses, the NOI, or net operating income. $167,000, that's just our purchase price, okay? So you divide this by this. If you do it on a calculator, it's going to come out with 0.03756, right? move the decimal 2 places over. So that's what we call in our world or in our lingo 3.8% cap rate. All right. So hope that makes sense. So this is a 3.8 cap. So dollar for dollar, you're probably better off buying this real estate than buying Verizon stock that's giving you 3%. So now you know I get 3.8% with this house, and I'd get 3% from Verizon. So, okay, so the house is going to give me a little bit more. Now, you know, I think, oh, maybe the housing market's going to go down, or maybe this is overpriced. Maybe Verizon's going to go down, maybe Verizon's going to go up. So there's factors that go into it, but this gives you a quick analysis on the cash flow. Does that make sense? All right. So hope that's helpful, guys. This is on a house. Let me show you a deal that came into my email inbox yesterday, okay? So, got an email yesterday. It's a 78-unit apartment complex, okay? So the purchase price is $3.5 million, all right? So, quick, pull out my back of my envelope. I write down, okay, what's the gross income for the year? Gross income for the year, $530,452. Cool. So these 78 units or 78 tenants are paying this much money per year. Remember, this is an annual number. Now, I look at, and a lot of times when you're looking at big complexes like that, not a lot of times, sometimes when you're looking at big complexes like this, they give you really good detailed numbers. And that's what I got yesterday. The numbers that I'm looking at, these are solid numbers. Now, obviously, I'm going to want to make sure in the due diligence that I find out and make sure that all those expenses are legit and correct, and that's called the due diligence period. But this is going to enable me to I'm going to submit an offer today on this particular deal. Okay? I'm going to submit the offer. We're probably going to counter back and forth with the seller. Maybe we'll go under agreement. Once we go under agreement, my job is to make sure that this is the correct number and that this is the correct number. That's what the job of the due diligence, but that's after we're under agreement. I'm not going to get involved in the minutia of that right now, because if they counter and we don't go under agreement, I'm just going to move on to the next deal. I got 3 more deals coming in my email tomorrow, or 10 more deals tomorrow. It's just, that's my process. So my net operating income on this 78-unit complex is $340,717. Cool. Okay. So, you know, should I buy this house or should I buy this complex? And let's just say I had $50 million to spend. Okay. And in other words, just money's not an issue. What would be the better investment? A house? A house I think is worth $200,000, or this complex? What's the best thing to do? So let's just do the quick cap rate. $340,717. You divide that by $3.5 million. These are real numbers, guys. I'm not pulling this from the sky. I talked to the broker. I think they want 3.9, but I said, look, we're going to have to be closer to that 3.5 figure. He said, I think we're going to be able to do that for you. So anyway, so that puts me at 0.09734 or a 9.73 cap. Okay. Now I'm going to get 3.8% cap rate on that house that we just looked at, or I'm going to get 9.73 cap on this 78 unit. You know, at face value, it looks like this might be the better investment, right? Let me show you guys something else that's really, really cool. Actually, before I go into that, cap rate can also be viewed as a level of risk. There's actually a lot of investors that say, Brian, I don't want to invest in any real estate that's over a 10 cap. I don't want to invest in any real estate that's over an 8 cap. Or I'm the type of investor that likes to invest in a 6 cap or 7 cap type property. And what they mean when they say that quickly like that is it's a risk tolerance. I've bought properties that were 20, 25 cap, but they were in terrible areas of the city, high risk type tenants. Now, I don't manage my properties. I use management companies to manage them. So again, it's not a huge deal for me, but I'm going to have a lot more turnover. They're going to beat the crap out of my properties. So that risk level goes up. So some investors say, I'm not interested in that game. And you can decide for yourself what's important to you. But cap rate also is a risk tolerance level. Second thing that I'll say is this. When you're looking at these expenses, you want to make sure that there's 3 categories included in those expenses. You want to make sure that a management fee is factored in. You want to make sure that there is a vacancy rate in there, and you want to make sure that there is a solid maintenance or repairs type number in there. And then you want to look at all the other costs, the taxes, the insurance, the the water, the sewer, trash, whatever. If you have to, if you have in this complex, we'd have to make sure that we were dealing with snow removal and mulching and all that kind of stuff. So you want to make sure that all those expenses are in there. And if you don't see management, vacancy, or maintenance, then you want to factor those in. I've had a lot of investors say, hey, Brian, I just add 30% for those three, 10, 10, and 10. I've had people that if they're buying in real conservative areas, really high-end areas, they'll do 5, 5, and 5. 5%, 5%, 5%. And when I say percent, I'm talking about 5% of the gross here, or 10% of the gross here. So I've heard it. It's pretty common. A lot of investors will do just 25%. Anyway, my point is, you just want to make sure that whenever you start to establish your cap rate, you want to make sure that the cap rates that you're figuring out are consistent with yourself. So if you're doing a 10, 10, and 10, and you're looking at 20 different deals, just figure in the 10% vacancy, 10% management, 10% repairs. Or if you're in a super high-end, nice area and you're not getting any counter offers, then maybe you want to adjust that down a little bit to a 5, 5, and 5, or 7, 7, and 7. Again, those are just quick ways, but I just want to make sure you guys understand that if somebody comes to me and says, hey, Brian, I got a 15 cap for you. I'm excited to see the 15 cap, but what I'm going to, inside my mind, I'm thinking, all right, I wonder if they factored in vacancy, management, maintenance, and I'm going to adjust those numbers quickly. All I say is this: great, I want to see that 15 cap. Just send me the current income and the current expenses. That's all I need, and I'll get you an offer today. And they say, oh, wow, you get me an offer today. Cool. So they send me the numbers, and I look through them, and I look for that vacancy, management, and maintenance, and I also just confirm that the rent seems to be in line. And then I quickly submit the offer, go under agreement, and then I've got the next 30 or 45 days to do what's called the due diligence period. In other words, I have a lot of interest in buying the property, assuming that the numbers that they showed me are correct. So once I know that, then I can go under agreement. All right. Hope that's not getting boring for you guys, but again, it's important. So what this is, guys, is this is learning. If you're not in investing and you're not in real estate, what you're learning here from me is a new language, okay? So if you want to move to France, it's probably a pretty good idea for you to buy Rosetta Stone and start learning French, right? That's what this is. If you want to get involved in real estate, you got to learn the language. You got to learn to speak the same language, and we've talked about that kind of stuff before. But that's what I'm teaching you here is just the language. All right. Lastly, this is the fun part, guys. Okay, this is where you take a property and you want to increase its value and you want to increase its cash flow. This is how we do it. Watch this. So this property I'm looking at has a $340,000 net operating income, right? That's what we took the income, we took out the expenses, $347,170, right? Now let's just pretend that I know that in this market, all the rents in that 78 unit complex are low. And I think, you know what? In the next 6-7 months, I could probably increase the rents $50 per unit. Okay, so I do $50 per unit times 78 units. I don't know if it's $3,900 or $4,000. I don't know what it is, but you multiply that by 12. So I'm going to increase the rental income for the year $46,800. So now I think in my mind, I'm going to buy this thing. I'm going to have my management company boost the rents or do whatever's necessary to boost the rents. That's going to take me to $387,517. Let's just say 2 years from now, my goal is to have a net operating income of $387,517, which in a lot of times is reasonable. Maybe the management company just never raised the rents for the last couple of years because they didn't want to lose tenants. Maybe it was a self-managed guy and he really liked the tenants and felt bad about raising rents. But the reality is things are becoming more expensive. So you've got to be on the front side of that and you have to continue to push your rents. All right. So now we got a new net operating income. And let's just pretend that in this area, I know that properties like this sell for about a 7.5 cap. Let's just pretend that that's what they sell for, okay? Now, if I know that they sell for 7.5 cap and I've increased the net operating income, watch this. This is the magic. You take the new net operating income, $387,517, right? We added the rents, and we divide that by what we know to be the correct cap rate. The correct cap rate is 0.075 in this market. All right? Now, this is called a pro forma. This is the future. This is not now. So you don't buy properties based on pro forma. You buy properties based on current cash flow. So in 2 years or a year or 2 years from now, I believe that my property is going to be worth 5.166893, $5.1 million instead of the 3.5 that I paid for it. Remember, I just paid, or I'm going under agreement today on a property that's $3.5 million. 2 years from now, I believe it to be worth 5.167 because I can push those rents, and I know that the cap rate is different in that area. So once you understand how to play with these numbers, now I know I've got a $5 million asset I'm going under agreement on today, and I'm buying it at a discount. I'm buying it at $3.5 million. So 2 years from now, theoretically, I would have added $1.67 million to my balance sheet. I would have increased my net worth by that. Does that make sense? Cool stuff. So guys, let me just close with this. Look, if you're not playing the cash flow game, if you're not learning financial intelligence, if you're not learning to speak this new language, you're going to be left in the dust. In our country, in the United States of America, the poor and the rich are diverging. The middle class is going away. And people that know how to speak this language are the people that are becoming abundantly wealthy. Just yesterday, this 78 unit came into my lap here. I'm going to submit the offer. I don't know if I'll buy it, but the opportunity is coming to me more and more and more because I've learned to speak this language and I'm learning to improve my business and investing skills. Okay? If you think this is just boring stuff and you're just going to focus on, buying new cars or liabilities or buying it, it's fine. But my point is, your future is likely in the very poor or lower middle class. So you got to learn this language. If you learn to play the cash flow game, play it and play it and play it. Play it online. It's free. Or buy the board game. The board game has this. It has your income statement, has your balance sheet. It's going to teach you how to be able to grow your income and grow your net worth. These are you can see the math is not hard. You just have to start to wrap your brain around how this all works. And if you do, you guys are going to become abundantly wealthy. And that's what I want. I want you guys to become incredibly wealthy. So thanks so much for watching, guys. Again, just a quick reminder, if you haven't subscribed, hit the subscribe button. It would be much appreciated. I hope this was helpful for you. And start doing it. It's quick, easy math. Just go on the local MLS or call a real estate agent. Say, hey, look, send me some deals, some rental deals, and get the numbers in and do this exercise. Gross income minus the expenses, net operating income, take that, divide it by the purchase price, and come up with your cap rate. Again, make sure you're taking out the vacancy management and repairs, but I hope it's helpful, guys. Sorry for the long video, but I truly hope that this is helpful, and I thank you so much for watching. Have a great day, guys, and keep moving forward.